Welcome everyone. Welcome to this panel on climate risk assessment. I guess we'll have the challenge to keep you awake just after lunch. That's always a nice timing for a panel. Welcome also again to lovely Dubrovnik. Now, for our panel today, we will focus on the challenges that we encounter, I guess both as supervisors, but also as industry on climate scenario analysis. We'll try to give you a state of play in terms of where we are. We'll talk about data challenges, we'll talk about parameters, where to go next, and hopefully also we'll try to give you a little bit of insight into what to expect for the near future. I'll be doing that not alone. I'll be joined by my distinguished fellow panelists, and I'm going to present them to you. So the first one is Patricio Espinosa, the Director of Prudential Insurance Regulation of the Financial Market Commission of Chile. He's joining us virtual, so welcome, Patricio. We also have to the left-hand side here, Hugh Francis, the Director of External Reporting Developments at Aviva. We have Robert Muir-Wood, Chief Research Officer of Risk Management Solutions, also joining us virtually. And we have Daniel Wang, as you know, the Chair of our IIS Climate Risk Steering Group, and also the Executive Director of the Insurance Department at the Monetary Authority of Singapore. Welcome to all of you. I'll hope we can have a nice discussion today. And also you as audience will be involved in the discussions. As already highlighted, we'll be having some polling questions, and I'm very much counting on your interaction and on your input of these polling questions, which we'll hopefully be able to use also during our discussions today. So I guess we'll kick off. And a first theme which we would like to elaborate is talking a little bit of where we are in terms of climate risk scenario analysis, to give you an idea of the state of play. And maybe let me start by asking a first question to Robert. Robert, you have contributed yourself also to the work of the IPCC. So maybe in order to set the scene, where do you think the world is in terms of addressing risk related to climate change?
Okay, well, thank you first of all for the invitation to be part of this panel. I got involved as a lead author with the IPCC Fourth Assessment Report in 2007 based on my work on climate catastrophes. At the time, climate scientists studied changes in means and maybe annual extremes, but not in rare catastrophes like hurricanes. Out of the recognition of the importance of catastrophes came the IPCC Special Report on Extremes in 2011, for which I was also a lead author. The science, as you say, the science has moved on. The confidence by which we can link changes in temperatures to human-derived emissions has become increasingly certain. For example, using attribution analysis, running global climate with and without the increase in greenhouse gases, climatologists found the extraordinary July 2021 Pacific Northwest heat wave, or heat dome, was 150 times more likely as a result of the buildup of human-derived greenhouse gas emissions. Effectively, these record temperatures could not have happened without climate change. And as a manifestation of the interdependence of climate phenomenon, the town in British Columbia where the highest of all temperatures was recorded, a day later burnt down in a wildfire. We now understand more of how the population of climate extremes is changing and will change. We need to anticipate what is coming. Catastrophe models, with their separation of modules for hazard, vulnerability, and exposure, provide an ideal tool for implementing future risk. We can modify the individual event rates in the model to reflect future climatology. Thank you.
Yeah, thank you very much, Robert. And before I move on to my next question, I'd like to maybe pop up the first polling question for you as an audience to participate to that. And let's give him a second to, yes, here we are. I'd like to know from you as an audience what you see as the main challenges, and this is both to the supervisors and the insurers in the audience, in terms of undertaking climate scenario analysis. Do you believe those are related to data challenges, data issues? Is it a lack of insufficient resources, a lack of expertise? Those two can be related. Or do you see any other priorities? Or maybe all of the above? So please give us your input, and we'll come back to the results of the question later on. Now, moving on to the next question, and maybe, Daniel, that's one for you coming up. You are leading the IAS work on climate risk. Can you maybe give us a snapshot of where supervisors are at present in terms of undertaking climate scenario analysis?
Yeah, so thank you, Dieter. Firstly, I just want to, again, also express my thanks for being invited on the panel and for the lovely surroundings, and so compliments to the host. On Dieter, your question, I would use the word journey to describe the current state of play among supervisors. Before the Climate Risk Steering Group at the IIS, before we started our work in earnest, we took a survey, we had made a survey of some of our members on the state of play insofar as scenario analysis is concerned. And at that point in time when we took the survey, 50% had carried out scenario analysis in some way or some form relating to climate change. 1/3 at that point in time were planning to do so, and the rest were in the midst of doing so. So I'm just trying to give you a flavor of that survey to show that there really is very keen interest among insurance supervisors to grapple with the issues and to make appropriate assessments in this emerging field. So in short, growing international consensus among the supervisors that climate scenario analysis it's an essential tool for assessing the effects of climate-related risks on our insurance sector, and certainly, I would dare say, the broader financial sector system. The Climate Risk Steering Group. So we are working really hard to provide timely guidance to assist our members in the IAIS so that they can start, continue, or further their journeys in this scenario analysis space. We are doing so through a combination of what we call knowledge-in workshops, as well, where we compile, speak to experts, speak to our peers, gather the info, and then push it out through what we call then knowledge-out sessions, where we'll, we hope enhance the capacity of our member supervisors. So these workshops are inclusive. It covers a range of topics, going into deep dives relating to various aspects of climate scenario analysis. You will be open for different time zones, and there will be introductory and also at advanced levels. And this will be held in the second half of this year, in fact, starting later this week. So taking a step back, I would say that it's a iterative cycle. Through the insurance core principles, through national legislation and requirements, you will bring up the awareness about climate scenario analysis, and this will be reinforced by those standards and principles that I was talking about. Through that, we will implement assessments through scenario analysis, and then we hope will be overall supported by good quality and available data. I'll come back to the data issues, I'm sure, at some point, but that is really the virtuous cycle that we hope to build. Thank you.
Thank you very much, Daniel. So you, maybe moving on to you, and can you give us a perspective on what challenges climate scenario analysis pose for insurers, for market participants, and are there maybe any particular balance sheet items or asset side, liability side, where you see more difficulties than others in terms of climate scenario analysis?
Yeah, sure, and just to reiterate, it's a pleasure to be here and a wonderful location. I think from our perspective, I mean, we as as industry, I think the use of a journey is a good way. We're on a journey on this. So if I take our company as Aviva, we've been making climate-related disclosures for a number of years, ranging from kind of like carbon intensity to now portfolio warming potential, investment in green assets, operational carbon emissions, and we'll come back to it later, but we've also, over the last 2 or 3 years, been doing climate value at risk as well. So I think there's definitely an evolving development. I mean, on balance sheet, it's both sides. It's the easy answer, it's both assets and liabilities. I think increasingly there's quite a bit of focus on the liability side and the underwriting that's probably coming more, you know, because we've got to face both transition and physical risk. I mean, to give an idea of state of play in terms of challenges, one of the things we did in the UK context, there's what they call the Climate Financial Risk Forum, and that was a joint initiative between industry, the PRA, and the FCA to try and develop, particularly on scenario analysis, how do we do it? So the report was issued in October, and there were a number of points made about what the key challenges are. They won't be a great surprise to people, but you know, I think they're probably just worth reiterating. I mean, one of the first points is that the breadth and magnitude of transitional and physical risk is very large. So basically, it affects all companies, all agencies in an economic sense, and therefore, you know, there are some additional complications that events are not non-linear, and there are also potential tipping points. So although we're very used to looking at unknown future events, you know, you're quite pushed or challenged into these areas in terms of the breadth. The second point was about the extended and uncertain time horizons and feedback loops. So Robert's kind of mentioned it. I mean, we know it's happening, but at what point and what time scale that's happening? And for many companies, it is getting beyond their kind of normal business planning cycle. So it's something that's happening into the future, and that adds additional complexities, such as, you know, what about social tipping points? What about what's going to be the pace of technology developments, and how are really the old sectors going to be impacted and when? So that's a timing one. I think a lot of it, especially on both physical but also transition, we're looking at, there are, you know, known weaknesses in many kind of like climate economic models. So, you know, most economic development models are kind of predicated on a certain element of certainty. And so actually trying to do this into a very fluid environment means that it's, you know, this non-linear dynamic nature makes it more challenging than some areas. The long time scales with discounting obviously impacts, and particularly when, and Robert's alluded to as well, if you get into the long scenarios, long 2050 on hothouse physical risks, you really are going quite towards the margin of some of these areas. The other one is, of course, it's that cognitive bias, is that it's not an area that we can predict based on known past performance. So we're kind of slightly going into the unknown. And probably the other one that no doubt we'll come back to is the data gaps and the comparability of the disclosures and the frameworks that are developing. That said, you know, and I don't think there's a silver bullet. I very much think that we are, as an industry, going on a journey. There's considerable effort being made by companies across the globe about how to develop climate metrics and modelling. It's far more advanced than it was even 2 or 3 years ago. And there's clearly an element and desire to develop best practice on that side. I mean, I think my key message on this has always been the best should not be the enemy of the good. And we're on a journey. And I think if industry and regulators are very much on the same page on this form of development, and I think acting together collaboratively, which we've done in a UK context, I think means that I think there's that important role that the IES companies and others can work together to try and seek how best to overcome these challenges.
Yeah, I couldn't agree more. And somewhere it's good to see that we as supervisors are more or less confronted with the same challenges as you are. The long-term perspective, the non-linear behavior, the data gaps, it all sounds very familiar to me. So thanks you. Maybe moving on to gather some experience on emerging markets and how they are dealing with climate risk. So Patricio, how is the Chilean regulator dealing with climate risk? You're a good example, I guess, of an EMDE country. And maybe within that line, what role do you see climate stress scenarios playing as a tool to measure the impact of climate risk on your insurance market?
Good morning, good afternoon of everybody. In first place, the Financial Market Commission is the integrated financial supervisor and regulator of Chile, oversees banks, insurance company, and the securities market. The Commission's legal mandate is to ensure the correct functioning, development, and stability of the financial market, which entail three objectives: financial stability, market conduct, and market development. The climate change threatens the achievement of each of these objectives, and therefore is part of the legal mandate of the Commission to face it. In this context, in September 2020, the Commission issued a strategy to face climate change. The Commission has determined that climate change is a strategic priority and formed a climate change working group, which implements the Commission strategy. And the strategy has three axes: to promote the disclosure of the climate-related risk, to promote the integration of climate-related risk into the risk management of the financial system, and to promote the development of the green financial market. And to that end, we have two lines of work. In first place is monitoring of risk, and in second place, assessment of our regulatory and supervisory framework. Respect to monitoring of risk, we are developing the tools and capacities to identify, assess, and monitor climate-related risk using analytical tools like scenario analysis and stress testing. We are currently running three stress testing initiatives. One of them is climate change stress test project for insurance company with the Inter-American Development Bank, and the second investment initiative, or 2°. In September 2018, the 2° introduced the PACTA tool. It is a free software that calculates the extent to which corporate capital expenditure and industrial asset behind a given equity, bond, or leading portfolio are aligned with various climate scenarios. We are looking and we are working actually with this software in our stress test of climate transition risk. Thank you.
Thank you very much, Patricio. And I think you've illustrated well that this is a challenge that where both developed economies and emerging markets are going to have to work together if we want to tackle some of those issues. Let's maybe take a look at the first results of our polling question, if we could try to bring them up. Let's see how the audience feels about. Well, that's pretty clear. It definitely means we we have quite some challenges. I see data issues, if we look at if we want to single them out, is the one that got most votes, but I think the picture is clear in terms of that it's not going to stop with the data issues, and that we are confronted with challenges in many areas if we're talking about climate scenario analysis. So actually, I like the outcome of the poll because it makes my transfer to the next topic much more easier, and the next topic is on data issues actually. So maybe here again to set the scene, I'm moving on to a question for Robert. Robert, you've been working with climate data now for a number of years. What progress have you seen over the last few years in this area, and what key data challenges do you believe are yet to be addressed in order to improve the data quality for our scenario analysis?
Well, thank you for the question. So we at Risk Management Solutions have become clearer from climate model results and from actual observations what is happening and what we can expect to happen. We can also see evidence of change, in particular in those perils with some of the strongest climate change signatures, like, for example, extreme rainfall intensity. However, there is also uncertainty, in particular, what will be the rise of atmospheric greenhouse gases at different dates into the future. And for this reason, we have developed perspectives on future catastrophe risks output at 5-year intervals all the way through to 2100 for 4 different representative concentration pathways, also known as RCPs, based on how rapidly we are able to reduce greenhouse gas emissions. We believe this span of future dates and the range of trajectories on greenhouse gases adequately covers the uncertainty space on climate change impacts. So a user of this matrix of future states with 17 5-year interval dates for 4 RCPs and in particular the regulator, wishing to ensure a consistent perspective across multiple portfolios or among different insurers and reinsurers, they might well want to pick one or two identified scenarios from across the plethora of possibilities. We can advise on what should be used, probably not too far out into the future, unless concerned with very long-term risks, and realistic and relatively conservative on RCPs. For example, you might pick a 2035 date for a RCP 8.5. For 6 catastrophe perils so far, that is European flood and windstorm, North Atlantic hurricane and US flood, as well as and wildfire and also Japan typhoon, we've developed this future probabilistic risk capability that can be run as simply as in our catastrophe models, generating future EP curves and average annualized losses for whatever exposure is applied, a single property, an insured portfolio, or even the whole industry. We will in time be producing and releasing future versions of all our climate catastrophe models. And just as the way that Lloyd's picks specific model scenarios so that the regulator can achieve consistency in results across the whole market, we recommend that regulators select specific model future dates and RCPs so as to obtain direct comparison of different insurers and reinsurers. Thank you.
Thank you, Robert. And it's good to hear that work is being conducted on evolving some of the scenario analysis, at least in the area of natural catastrophes, as you pinpoint to. We'll continue to discuss about data issues, and while we do that, I'd like to bring up already a next polling question for the audience. So in which area do you believe, and now we're looking at the balance sheet, of course, is most work required to better assess the climate risk using the scenario analysis? Should we look or be more worried about the asset side or the liability side? And should we then focus either on the transition or the physical risk? So you have 4 options and 4 combinations possible here, and we would very much appreciate the input of the audience here. Now, back to the data issues. Daniel, moving on to a question for you. What key data elements do you believe still need to be addressed to conduct a more effective scenario analysis, and in the end to better understand the potential financial stability risk that may be caused by climate change?
Sure. Maybe let's take a step back, because we, as whether it's insurance supervisors or at the firm level, we tend to focus on what we don't know and we worry about it. But sometimes we forget how much work has already been done and the progress that has been made. So I thought, let's get also a bit of a balanced picture here. For instance, my colleague on the right and his firm doing good work in trying to overcome some of these data challenges. And we know that there are open source data platforms increasingly being discussed and trying to be put in place. So the good thing is that there's a single-minded focus to confront this formidable data challenge, and I hope that we don't ignore the progress that has already been made. But nonetheless, the data challenge is, frankly speaking, quite formidable, and they do exist on both sides of the balance sheet, exactly like what Hugh just mentioned. So let me just focus on each part of the balance sheet and just share some thoughts. On the liability side, just give 2 examples. Notwithstanding what Robert is saying, where increasingly there's more data available, and the IPCC reports and the tables in the IPCC reports are a great help. But at the same time, there will be challenges on the insurer firm level side. Just give a few examples. There continues to be an info gap on the physical location of exposures by some insurers. For example, that observe on wholesale portfolio risk exposures on reinsurance treaties. Then you add on to that incompatibility of certain physical risk parameters with the insurer's catastrophe or loss models. So just to give a bit more context. So while the supervisor may prescribe specific parameters, such as rising sea levels as part of a scenario analysis exercise or something like that, some insurers will be unable to apply this to their asset exposure or liabilities exposure in this case, as they lack granular physical information to determine if their underlying risks are located near or at the coastal areas. So that's one problem. Second, their CAT or loss models may well have been designed to consider shifts in frequency and severity of specific and limited events like a typhoon or a hurricane, but may not be able to design to model events like rising sea levels or rising surface temperatures. So this is an example of the challenge that we face here. Then on the asset side, okay, the good news is that the data is better. Why? Because insurers have industry classification codes for their assets, and this allows them to map it back to their portfolios and their exposures. So that's good. So the intent is that we should be then improving on the asset side what we already have. So, and this is where Dieter and the work at IAIS comes in. So this year's global monitoring exercise, we are seeking to improve on the assets data that we had collected last year, and we're building on this, where we collected investment exposures. We're collecting a bit more in-depth with better breakdowns, and hopefully through the collection exercise, we have a good report to share with everyone. We are also, under the GME exercise, collecting liabilities data at a jurisdiction level for the first time. So, such as, for instance, gross incurred claims by business lines and modeled CAT losses. So, I think with this exercise, what is being done at a firm level, what is being done at the IAIS level, global level, hopefully will help in time bring some convergence to this data gap. It'd also be remiss of me to not mention the work of the ISSB, because with greater disclosures, not just from the financial institutions, but from the broader other sectors of the economy, over time, on a set of harmonized, consistent disclosure standards on sustainability, this will also provide better data, better information for insurers, for all of us as supervisors, to use that information, whether for risk management or for supervisory assessments.
Thank you very much, Daniel. And before moving to Patricio, maybe directly to you, because I mean you must be facing, I guess, very similar challenges also as we do in terms of data gaps. So what are your data challenges in particular when you try to develop a climate risk scenario? And do you see what can the industry collectively do maybe to help filling some of these gaps?
Yeah. If I take those both in turn, then I think we all see, I think there's a challenge beyond industry that's not under our control. I think like everybody else in industry, we find that we're reliant on information from other companies, we're reliant on external data providers, which we know do have some inherent limitations, as you refer to, Daniel. And but our purpose is to try and validate those to the extent we can and back test it to see whether it's kind of like consistent with our knowledge. So like we develop those internal processes and capabilities to an extent, and we go external, work with third parties, whether it's on sovereign risk or other areas, to try and fill those gaps over a period of time. So I think that's developing. But if you think about what are the types of information that we need, so what do we need? We need scope 1, 2, and 3 emissions from companies. You need that aggregate, you need it broken down by company, you need it by jurisdiction. We need company transition plans to really understand how those emissions will reduce over time and what targets, particularly those companies that we're investing in, are doing that. We need something about the current, historic, and future expected carbon price exposure. We need granular asset level location data, particularly on physical risk, and we'll come back to that. We need to kind of like think about the changes in frequencies, information on that. We need breakdown of revenue split by type of business that companies, not talking about the sector, but the corporates that we invest in. Some are private, some are public. We need CapEx, we need R&D spend. There's lots of elements of data there. And then I think in addition, there are certain methodological assumptions that are important, like, well, what is a pathway? What the companies that are investing, what is their pathway? What the climate policy assumptions? I mean, it's interesting, it's quite timely because, as you may know, in a UK context, the Bank of England just completed and published the results of the CBES exercise, which is a large exercise with the banks and insurers. And one of the key findings was, I'll quote unquote, is the inability to capture appropriate and robust data in certain areas is a common limitation, which means many climate risks are only being partially measured. I think that's probably,
summarizes it.
Yeah, summarizes it pretty well. But if you think of the type of examples that were brought up in the detailed report, and Daniel's mentioned some of them, is that information about corporate assets. Where is it located, to be able to get physical data on the physical side. It's standardized information about value chain emissions, financed emissions, particularly if you're looking at corporate counterparty exposures, public reports, how we got that information to that exercise. And so, the call from the bank was, bank and insurers need to progress on data, but also recognise that that's going to need a joint action to try and help fill those gaps. I mean, you then talk about companies. I think industry has done a lot of work. We've done that through the CRO forum. We've done it through joint collaboration, where you have forums, often domestic, sometimes regional, where we're working teams. Obviously, there's the Net Asset Insurance Alliance and the Net Zero Asset Owners Alliance. There's definitely collective action from companies engaging with public bodies, regulators, and bodies to try and fill that gap and try and improve those. But I do think that there's only so much that industry can do. Without having those external exogenous assistants that actually help to complete the picture. I mean, we have called for many years for mandatory TCFDs because we need that information. We're similarly strongly thinking that climate transition plans need to be mandatory because we need to be able to collect that data, but you then need a framework that's going to be developed. So we're strong supporters. You mentioned the ISSB. Why? Because we're reliant on having an overall framework to get some consistent high quality information, because particularly on our investment side, we really do need to understand the pathways and what's going to happen on that side. So I think we have a common goal, but some of that, we will do what we can as an industry, but there are definitely a framework that needs to be built around that actually provides that data that we need. But we hope that the actions, and I think particularly over the last couple of years, whether it's at jurisdictional or global level, are helping to hopefully fill the gap. But then we get this disconnect about have we got the information, when do we need to disclose it? So I think we're on a journey together, but we definitely are reliant on those broader exogenous improvements to provide the quality of data that we need.
Okay, thank you very much, Hugh. Can we, in the meanwhile, maybe bring up the results of our polling question? So here we are. Seems that we have, as expected, both challenges on the asset and liability side. I do see that lots of people mention the transition risk, rather on the asset and liability side, more than physical risk. That's at least an interesting observation. At least it may help us, Daniel, also to know where to focus in the next few months and years. Now, Patricio, I'll move back to you because you've mentioned actually that you performed a climate risk stress exercise. So I'll be curious to know what results were obtained and what lessons did you learn from performing that exercise in your country?
Well, I can say the analysis made by PACTA tool is limited in terms of total investment coverage. It's only coverage 21% of total investment of the insurance company in Chile. The foregoing occur because only that percentage of the bonds and equities of insurance company had an associated ISIN or an international securities identification number, which is the key used by PACTA to identify those assets with the sectors of economic activity affected by the transition risk. The results indicate that the stress on both equities and fixed income investment is low. However, in those investments affected by the transition risk, it is significant. The foregoing, given that the issuers have energy matrices that are sensitive to this type of risk and that are misaligned with the sustainable development scenarios. Therefore, what can be highlighted is that there is a significant gap between the alignment of the investment strategy of the insurance company with respect to an investment portfolio under a sustainable development scenario. They are far from the current composition of the market and even further from a sustainable benchmark. Thank you.
Thank you very much, Patricio. And it's time for the next polling question. So if possible, I'd like to, yes, here we are. So in terms of, and this is linking, of course, to our next big theme, in terms of key parameters, design factors of the scenario, which scenario design factors pose, according to the audience, the greatest challenges for climate risk scenario analysis? Is it the choices that you have to make at the level of the balance sheet? Is it the granularity of the data required, which was already mentioned here also both by Daniel and you? Is it the scope of the balance sheet that needs to be captured? We've heard already assets and liabilities. Or is it rather the long time horizon and the uncertainties that go with that? We've also have a rest category other, so it could be that we may not have captured the main challenge, and then we would also like to know, of course, if you believe that there's something else going on. Okay, on to the key parameters and the challenges they pose for a scenario analysis in terms of climate risk. So you, turning first back to you, I mean, you may have noticed probably that we as supervisors have been working on it, and sometimes also this results in different approaches in terms of climate risk scenario analysis, also in terms of scenario design, and in particular on issues which relate to the balance sheet and in the number of years that needs to be projected in terms of the scenario analysis within the scope that is foreseen. There could be differences. And what impact do these design decisions have on your ability as an insurer to run these exercises?
Well, I mentioned the CBES exercise, so it may be just, I mean, the one that we're most familiar with, and our team spent a lot of time doing this last year. You know, so we're one of 10 insurers, some global, some UK-based, who basically undertook that exercise, which was looking at the resilience of both the insurance and the banking exercise. Primarily, you know, that was looking at kind of like 3 scenarios. So the scenarios were kind of like early policy action, late policy action, both really looking at transition risk, and then no additional action, which particularly picking up on the physical risk. But, you know, those were the 3 scenarios. And that was done over an extended 30-year modelling horizon. And the bank provided the macroeconomic aspect and the aspects. I mean, I would say that's probably a hybrid. I mean, it was actually by its nature, the loss projections were based on the participants' their balance sheet as it's 2020. So in that respect, it was static. But basically, we were then asked to qualitatively say, well, what actions would we take? So although I think it was a static basis, we had 2 rounds of qualitatively, what actions would you start taking based on that? And I think that to us was a sensible approach. We know that the interpretation of results is more straightforward by doing that. And we also knew that it allowed us to focus on the numbers in that and the quantitative stuff in that regard, but it gave us then to think across what separate focus would we do on the actions. Now, we do know that we think that was basically sensible and pragmatic. We do know there's some limitations of that. You know, you could have gone dynamic. I would actually personally think that, you know, you've got to learn to walk before you can run. And I think in that respect, it was a good approach to do, because I think you need to really understand the impacts on your balance sheet as is, and then start thinking of the consequence rather than try and make dynamic at the outset. So, you know, the static followed by some good qualitative work, I think is what we've experienced, and we can see the logic from that from a regulator's perspective as well.
Okay, good to know that sometimes we can be logic as well. Daniel, please, there is a lot of activity on climate scenario analysis, also on our side, across the globe, I dare to say. Patricio has mentioned how also emerging markets are working on it. Some insurers have flagged concerns about inconsistencies in terms of key scenario design elements. We know that some supervisors have taken other nuances in certain areas. How can we address this issue as supervisors?
Oh, that's a pretty tough question. Okay, let's make no mistake about this. Scenario analysis can be a complex exercise. you are talking about applying climate scenarios in practice, certainly it's not straightforward. You have models, you have data, and then you have analytical frameworks that are new. And for many supervisors, for probably many insurers as well. So this is complex territory. And the other area is that the transmission channels to assess how it affects financial stability, how it affects your firm's level, at a jurisdiction level, at a firm level, can be complex and certainly subject to uncertainty. So it is, in a way, not that surprising that at least at this initial stage, you are going to have some differing approaches and inconsistencies in the design elements. So, but having that as the context, I think there are at least two great initiatives that are going on now that will bring that convergence. So firstly, I think Hugh already mentioned NGFS scenarios, right? It was used in the CBES. It's being used in many of our jurisdictions, including mine in Singapore. And so the increased adoption of these scenarios with appropriate tailoring to local conditions will achieve greater consistency in the key scenario design elements. So that's the first point. Second way, I guess, is that precisely what I mentioned in my earlier remarks. There is greater sharing of best practices, and I would say very good and close collaboration between regulators, insurers, licensees, and the experts in this field, whether they are the data experts, whether they are the people like Robert, right? To encourage greater convergence in scenario design. And again, mentioning my CRSG work, we are doing this knowledge out sessions to bring about that exchange of good practices. So that will be the other way to bring about less inconsistencies and greater convergence in practices. But having said that, I also, wearing my supervisor hat, just need to make that quite clear, because I think that there will always, in a way, be some inconsistencies in the key scenario design elements, whether it's the choice of scenario or the parameterization of the scenarios. Because supervisors should and will continue to calibrate design elements according to their local context, and that's extremely important. And it's vital that as supervisors, we continue to challenge the assumptions and the models and encourage differing views so that the overall analysis is robust, considers all key relevant scenarios, because it would be a mistake, I would think, if the whole world just uses those 3 scenarios and nothing else. And that would be quite dangerous, because it's not only groupthink, right? It's one thing, and that's a problem. So all said, I think that adoption of standardized scenarios and greater knowledge sharing will achieve some of that convergence. But as supervisors, we will continue to apply our own independent judgment to ensure that the overall analysis is credible, robust, yet comparable.
Yeah, thank you, Daniel. I think that summarizes it well. We're doing efforts to increase our consistency, but be aware that that doesn't necessarily mean that you'll always be asked the same scenario across the globe and for future years to come. Thanks, Daniel. Now, could we maybe get the results in the meanwhile of our third polling question? Here we are. That's also quite clear. So we have both the time horizon and again the granularity of the data required, which are the top choices. Maybe we'll have some time at the end to also come back to the time horizon issue, because you mentioned it as well. It's definitely one of the challenges here. Thanks to the audience for that input. And this links to my next question also to Robert again. I'm sure, Robert, that you have been approached also by insurers to help them out in terms of climate scenario. What steps do insurers take to ensure they fully understand the assumptions underlying the climate models, and what steps do you have to take, you feel, to explain to them what is happening in these models, and how do you interact in that sense with your clients?
Well, thank you for the question. It's a very important one. I mean, it's extremely important. This is a new area of modeling, and any insurer or any regulator exploring the implications of future risk, they need to understand all the assumptions in models on which the modification of current climate change is based. We have in-house climatologists who have developed and applied the variations in event rates in these future risk models, and I think the situation is similar to that of when catastrophe models were first introduced. That it became really important to sort of explain, to sit down, in particular with the regulators, with the supervisors, and get them to kick the tires of these models and test the assumptions and challenge those who have made them in order to get to the point that they feel confident that actually these perspectives of future risk are sufficiently robust, that the uncertainty is effectively represented in the choice of these concentration pathway alternatives, and that we need to go through this process, and I think it's only just begun. I look forward to many meetings and sessions where we do get the opportunity to explain and get challenged around how these models have been developed.
Yeah, thanks, Robert. Indeed, some way to go to increase our understanding, I would say, of some of these models. Thanks for flagging that. Now, it's maybe time to look a little bit into the future, and in this last set of questions, I'll try to figure out with my fellow panelists what to expect actually. So, maybe turning to you first. Could you maybe share any implications from past scenario analysis that Aviva has conducted? For instance, has this led to any changes within the business of Aviva, or how do you look at risks? Has it had any implications, this scenario analysis? Has this helped you to understand certain elements related also to climate risk?
Yeah, I would say very much. I think I mentioned earlier our climate value at risk measurement, which is really looking at impact to shareholders fund, and what we've been publishing that for the last 2 or 3 years, and what that's trying to do is looking at the 4 IPC scenarios and saying what is the impact on that. Interestingly, very similar to results, not surprisingly, to the CBES exercise, which is early action is better than late action, which is better than no action. It's effectively the summary for insurers. But I think in that, particularly you see the exposure you get to the 4-degree scenario, which is, and it's not just physical risk, because effectively most people think you can reprice physical risk. There's definitely kind of like an issue for the IAS and SIF in terms of, what happened about insurability, but there's that pricing potential on physical risk. But actually, you then realise actually the dominant impact of low growth on the investment risk, on the transition on the investment side as well. Even in those kind of like really hothouse scenarios, you do see that do that. And from our side, in terms of opportunity or upside, you really are in that 1.5 to 2% scenario. Is the one where you think, well, actually, if you're smart at the pace of transition, that's where you can upside, where you're basically looking to invest in new technologies, trying to transition, use your influence to help the transition, help those extant investments as well as future investments in those areas. So we definitely see there are clear benefits of doing that. For us, what it led to us ultimately, well, not this particularly, but we announced in March 2021 our own climate goals, which were become net zero as a company by 2040, to achieve 25% reduction of carbon intensity in assets by 2025, 60% by 2030, and then have net zero operations and supply chain by 2030. And I think the combination of that plus the measurement, because it's well known that you manage what you can measure. And so I think the ability to formulate this allows you to look at this in a more coherent way and to actually really make certain it's embedded within the organisation. I think that's what's most important, whether it's within the operations or within the risk management framework. So you need to get it into your business decision-making processes. We're increasingly using it within our risk appetite. And also, as soon as you start making external commitments, you should be measuring against those external commitments, because quite rightly people say, and then, where the rubber hits the road, remuneration for senior management is now linked through onto some of these. We've got one on climate, we've got two on diversity and inclusion. So you can see it starting to drive through the organisation in a way that for many companies it wasn't doing it 4 or 5 years ago. I mean, the other thing that we did is that we issued our transition plan in March 2022. So, you know, if we're going to encourage that from other parties, we need to be doing it. You know, I think that's one of the messages for the industry is we need to be leading the charge if we're expecting other industries to do the same. So when we announce that, one of the things we do, we're looking at in terms of what are our targets, what are activities, what are the outcomes and priorities that we're looking at. And I suppose as we do that, you know, you're looking at your baseline measurement, you're thinking about what's the target setting that you need to get in certain scenarios, and what business actions do you actually make. And I think that that's kind of like where it's becoming real for a business, is at the point you can take the theoretical and you do your scenario analysis and say, well, how's that going to change my behavior? And as you kind of like measure through, I mean, we look at it in terms of investment, we'll look at it in terms of underwriting, we'll look at supply chain, claims management. You can see it starts to pervade across the organisation, where you're actually making every decision in the context, well, that's our external goal, these are scenarios we face, how do we actually meet that? So I think for a lot of companies it's now becoming very real because it's becoming measurable. At the point it becomes measurable, it becomes manageable.
Yeah, thanks for shedding some light on that. And as you say, insurers are well placed to also give a good leading example here in this area. Thanks. Patricia, I'm moving back to you. What actions do you believe or do you think the regulator should take to align the incentives of insurance companies with investments in issuers of energy matrices aligned with the sustainable development benchmark?
Well, between regulatory action to align the incentives of insurance company with investment by issuers of energy matrices aligned with the sustainable development benchmark, we can mention in first place the regulator can carry out work to provide adequate incentives for companies to adjust their investment in issuers whose energy matrices are aligned with a sustainable development benchmark. In case of not putting the correct incentives, the investor only seeks to maximize the profitability of his investment, and therefore going with give it has not internalized negative externalities in its returns in its investment decisions. The challenge then is to align both objectives, the incentives of the local institutional investor with the matrices of sustainable energy development. One way is to establish dissemination of best practices and principles regarding how to manage the climate risk and the transition risk, and for the insurance company to inform the general public and the policyholders through their annual reports or yearbooks what action they are taking in such sense to mitigate this risk and how they are incorporating them into investment decisions. The idea is the companies must generate a gradual process of investment towards sustainable investment. Thank you.
Yeah, thanks, Patricia, and thanks indeed also for flagging that how we can help at least to defining some best practices in this area. Robert, allow me to move back to you. We've seen recent new data that should suggest a 50-50 chance of average global temperature reaching 1.5 degrees above pre-industrial levels in the next 5 years, actually. So first, what does this mean in terms of a tipping point? And most importantly for this panel, how could this impact, or what does this mean in terms of impact for the insurance sector?
Thank you for the question. I mean, if we look around the world, I don't think there's any chance that we will stay within the 1.5 degree centigrade target. There are simply too many renegade countries in the world to everybody to sign up to have sufficient reduction in emissions on a rapid timescale. So the only real question is when Earth temperature exceeds that threshold in 5 years or 10 years or maybe 15 years. I think the target was deliberately set as a challenge beyond 1.5 degrees, there is increased uncertainty around what non-linear greenhouse gas emission or reflectivity or natural sequestration feedback processes will be accelerated, whether in the Arctic tundra or in the Amazon rainforests. As the world grows warmer, we open ourselves up to more potential tipping points. I mean, just to sort of identify one of them, if, for example, we detected across 2 or 3 years that there had
it seems that we lost Robert. Can I check whether is it Patricio? You can still hear us,
airports.
right?
I can still hear you. Yeah.
Yeah.
Can you hear me?
Okay, sorry, Robert.
I
We
can
missed
hear you.
we missed a few sentences at the end. Go ahead and repeat them.
Okay. I mean, I was just saying that beyond the 1.5 degrees, there is this increased uncertainty around what is going to happen, especially in terms of feedback processes becoming accelerated, whether in the Arctic tundra or in the Amazon rainforests. And as the world grows warmer, we open ourselves up to more potential tipping points. And one example of the way this could work, I mean, if we discovered across 2 or 3 year period that sea level rise globally had increased by, say, 50% relative to what the rise had been before the last few years, then that would have an immediate impact on the value of trillions of dollars of assets that are located just above high tide level. Things like ports, airports built on former salt marshes like JFK in New York, power plants, refineries, as well as all the property protected by seawalls that will now be on an accelerated risk trajectory. All such changes will have insurance risk cost and insurability implications. That is why we need to explore future risk, including the situation, just as with California wildfire, where the future arrives faster than anticipated. Thank you.
Thanks, Robert, and thanks for that, let's say, harsh warning. I think it's unfortunately a reality we need to face, and as you illustrate, a reality which also impacts insurance companies. Now, as a last question, and I'm sure the audience will be interested to hear from you, Daniel, what's up in terms of IAS work, in terms of climate risk? What can we expect?
In fact, I'm still trying to digest what Robert just said. It's really
me
sobering. And it just gives and emphasizes the impetus in which we have to, as insurers and as the insurance ecosystem, including the supervisors, how much faster we have to do our work, how much more we have to upskill ourselves to tackle this challenge. So the Climate Risk Steering Group, IIS as a whole, we are definitely going to do our part. So there are a few areas, right, I can see moving forward. Firstly, the data collected under the global monitoring exercise, I think it will be a good starting point over time for supervisors to consider such climate data fields and elements in their regulatory reporting, i.e. through the GME collection template. Potentially it can become a global baseline for supervisors and insurers to sort of onboard those data elements and then from there make your projections, make your assessments, make your analysis. Second, I think IIS will definitely want to work and continue to work with various standard setters. I've already mentioned the ISSB, but certainly also the NGFS, and in our side of our sector, the Sustainability Insurance Forum, and so on. Because this is not an insurance sector issue, this is not an Aviva issue, this is a cross-financial sector, whole of economy, whole of globe issue. And so coordination, learning from each other is going to be very vital. We've already flagged the formidable data challenges. So I think certainly in that next phase of work, we want to see what the IAS can do to enhance data availability, and then from the output from the ISSB, and then increasingly at the firm level as financial institutions start making public their net zero transition plans. We also hope that there will be greater encouragement at the national level for non-financial institutions to also start pushing out those transition plans. Because there are also countries right now who have not really set or made clear their country level net zero targets. So until you do that, you still need sectoral pathways to get to whatever those targets are, and then that's where we can see where financial institutions, including insurers, can play the part. So that's that global thing. And IIS, the CRSG, we will definitely find our way and navigate that space and see where we can contribute and where we can help. But the bottom line, I think, I want to come back to the word I used right at the start, is the journey word, right? The supervisors, especially in this field, will want to journey alongside insurers to understand, engage insurers and our licensees on your climate risk exposures, transition plans, and the pathways that you plan to take. And this journey is an exercise in togetherness, right? We have to follow this path, learn from each other, because this is an existential issue.
Thank you, Daniel. So this leaves us to some time for audience questions, I believe. So we'll be happy to at least try to answer your questions. So if you would like to ask a question to me or my fellow panelists, please go ahead. Just tell us who you are and which organization you represent. We should have microphones going around in the audience. Yes, I think I have a hand up here.
I have a mic. Dieter, shall I go ahead?
Yeah, it works.
Okay. I'm Morik Fullalove from the Fullalove Consulting Group. I have a question both to you as a company representative, but also to the supervisors. In doing these reports and as you're exploring them, how much of the data can be and should be prepared on a group level, and how much needs to be localized to the companies, and does this vary a bit with whether you're talking about physical risk or transition risk or assets or liabilities? Because I think we've seen that with ORSAs, that some very centralized managed companies do a single ORSA, and there's a great burden to prepare an individualized ORSA for a legal entity. So we're of some concern that we want to find the right balance there in terms of this reporting as well.
Yeah, thank you. I think finding the right balance is indeed the tricky part. I don't know you, Daniel, any initial reactions?
Yeah, I mean, you won't be surprised to hear that. I mean, we definitely look at this as a group level exercise rather than individual. So you have to drill down and understand where your the assets are. But I mean, if you think about it, for us, it's very difficult to do it on an entity basis because so many of your investments and assets are held all over the world as well. So it's not localized in some sense. Maybe some of the liability side is localized, but generally, for us, we will manage it and look at it as a group exercise. So I think that, you need to be able to drill down to understand in the local, when you get down to the individual sources of every entity. But we definitely see this as a group issue and something that we'll look to manage at group. Having said that, clearly, as you drill down on science of underwriting, it could well be, the physical risks coming out of your GI business may be very difficult to kind of like the second order, but equally order physical risks that are flowing through onto your life side as well. So I think you have to look through, but I don't think you want to perform it bottom up and then we would be going top down and then looking at what the implications are as and when we do the qualitative work and quantitative work.
In fact, I couldn't agree more. So I'm not really sure that this answer will be very a pleasant sounding one, but it sounds like both Hugh and I are saying it's both, right? So certainly at the group level, and I think on the asset transition exposures, it lends itself better to centralized assessments, and but when you come into the liability side, especially when you have if you're a large reinsurer, or if you are even a direct insurer but you have representation in multiple regions, you do need to go down into the regional level, because if they are as far-flung as an operation in Japan and the other one in the US or another one in the Africas, natural perils hit all of these regions very differently. So unfortunately, at some point, especially on the liability side, you do need to take into account those localized settings and risks, as I've already mentioned.
Yeah. I have a question here, front of the.
Apparently, I got the mic instead.
Yeah, no problem.
Peter.
Go ahead.
Alistair Campbell. I run an insurance guarantee fund in Canada, but I'm here also in my role as a member of the management committee for the International Forum of Insurance Guarantee Schemes. My question's about model risk. We recently partnered with the Toronto Centre to develop a case study about a fascinating recent insurance insolvency where a company failed in 10 days as a result of, as Robert just described so inspiringly, what's happening in California. And a wildfire simply took down this company. So I think most of us who think about insurance supervision think insurance companies fail in slow motion. We're not like banks. This company went under almost instantly because its modeling was inadequate to a type of climate risk inspired wildfire where they had never anticipated that the entire market share they had in a trading territory would be completely burnt. And so my question is around how supervisors are to think at the IAIS level about taking an insurer's estimation of required assets to back liabilities with aggregate risk measured X. What if the model's wrong? And what if the model is wrong simply because time has happened much faster than anticipated and the climate has shifted and worse things than anticipated happen?
Yeah, very good question. And what if the model is wrong? I think it's in many areas as a supervisor you are confronted with this model risk. Maybe first go to Robert. Robert, do you have any views on that? What if the model is wrong? Is there anything we can do?
Well, I mean, the peril, you've asked this question on California wildfire, I mean, is the peril for which we've seen the most rapid changes of any region and peril. So it's one in which the loss has been doubling about every 6 years or something. I mean, it's been showing exponential increase in risk. And one challenge in California, I believe, is that the regulator has required that actually insurance companies assess their risk against their historical experience. So there's this a challenge in particular in the US where there is more activity questioning the existence of climate change, and a regulator may be more looking after the interest of the customers than the insurance companies. That there's a requirement to look at what the historical average of risk has been, and not understand how that risk has been changing, even right down to changing in the last 5 or 10 years. So I'm sorry to hear about this company going out of business, and it's a major challenge that regulators should be backing models that include climate change, whether this is for flood or wildfire, and if they do not include the nature of climate change in the modeling, then there could well be situations where a company could go out of business as a result.
I think this teaches us again also never to fully rely on models, I would say. Maybe is there anything insurers can do to manage a little bit this model risk?
From my perspective, is that a model risk? Is that a reserving risk? I mean, I don't know if that's a model. I mean, in some respects, I think actually, to me, that sounds a bit more like a reserving risk crystallizing. But I'm a bit more half full rather than half empty. I think actually, in some respects, insurers, and we're all looking to ask to think about the unthinkable. So we're now into a scenario, particularly where you should be looking at your book and think, what happens that something you really didn't expect? Now, you'd expect as normal reserving, you'd have been looking at that for Nat Cat exposure anyway, and you expect to be reinsured for that. You would hope you'd be covering that. But in some respects, because our horizons are being expanded because of the climate risk scenario work, it does allow us to put in scenarios that maybe 4 years ago you wouldn't have thought about. So I think in some respects, if it works well, it should greater comfort to the regulator as well as the company management who are ultimately responsible that if I think the unthinkable and I will survive, and I talk about, so we've been going for about 326 years, we lost a lot in San Francisco in about 1905. So it's always been the case that you could have an exposure, but you have to have a well-diversified, well-reinsured book. So to my mind, I would differentiate reserving underestimation from model risk, and hopefully expanding our horizons should mitigate some of that risk rather than actually create some.
Yeah, thank you for that. Let's take another question. I see Yoshi is been very keen to.
Thank you, Yoshikawa from OECD. So my question is mainly Daniel, but maybe he also put some input. Daniel, you mentioned that this is a journey, right? So, and I understand this scenario testing and data is very important exercise, but my question to you is, what's your destination for next few years? Or maybe one destination, but maybe in a long term, next 5-10 years. Do we have any clear idea? Or a little bit, my thought, you mentioned this NGFS high-level macro scenario, and IIS intend to create some scenario. You mentioned it should be localized, right? It's a huge difference by natural disaster and so on. So what type of scenario you are in mind or that IIS is going to develop? And also data. I understand this scenario is very much linked with data. So what type of data do you want to collect? And if global standard setters, mindset or objective, ultimately it should be globally consistent or at least comparable. So in the ultimate stage, do you intend to create something, scenario or data, which is sort of globally comparable or so on? And in that case, I assume that your scenario test and the data is a template of data collection, not only as a regulator, but also regulator towards the industry or companies. So just I want to know which destination are you in mind next few years and in the long term?
Firstly, scenario analysis and data are twins. They are joined at the hip, right? You can't do good scenario analysis without good, solid data, and and where data is lacking, that's exactly where you need to do more scenario analysis, not less. Right? So that's the first point. In terms of ultimate destination, in an ideal world, sooner rather than later, given what Robert has shared earlier, there needs to be a set of downstream complementary scenarios from the 3 or 4 high level ones that the MGFS has come up with. And precisely my point, this has to come down to a regional context, localized context, and that is not easy because it's easy for any one of us in this room to dream up a scenario. That's not difficult, but precisely it needs to be science-based. It needs to complement with satellite imagery and data. All this takes time, and all this takes work. But the IPCC has already set the tone and done amazing work in that area. And the issue is for these, be it scenarios or the underlying data, to be shared across in a more accessible way. So it comes back to how can all of us on board. You can imagine that those in possession of the data is now going to charge an arm and a leg for it now that they realize that it's important, right? So can we make this more accessible to the financial institutions? How can we have platforms to aggregate the data and to exchange and share the data? There are projects in Europe ongoing now. There's certainly one in Singapore. I can tell you, when I get off stage, what some of these initiatives are to make it more open source, more accessible. And then again, just coming back to what I'm saying about the ISSP's work, and then increasingly as firms publish or at least share their transition plans, this adds to the ecosystem, right? This adds to the information and the knowledge, and I think that's really where we want to get at.
Thank you, Daniel.
I reiterate, I mean, the point for us about the global standard is really, really important for us. I think that's the one thing the industry's been calling for a while, is to have a clear set of consistent information, because we invest globally. So I think, we were very supportive of the COP26. We were very supportive of the move of the ISB. We think that's absolutely critical to deliver. That may happen in different ways with the nuances, but, in different jurisdictions. But we need that clear baseline of this is the information we have, because that will increasingly help us to fill the data gap. I think in terms of, there are two elements about what's the destination, what's the objective. I think for individual companies, we'll make individual pledges, but actually we have to try and take the global economy on a journey as well. So I think one of our objectives, practically what you're trying to do, you want to set what your baseline scenario is. You want to try and take where am I on that trajectory, and what do I need to make certain I'm back on track. You can try and do that for you as an individual company. I think the important thing for insurers to do is to think about within that, how do they encourage the companies that we insure, the companies that we invest, to actually take that same journey. So, for example, one of the ones that we look at is we look at our portfolio warming potential. So we know what it is. We know where the FTSE's going. What you want to be able to do is to be using your influence to try and encourage everyone to follow a journey, because ultimately, just insurers getting there isn't going to help. That's why the scope 3 is no more important than the 1 and 2, because ultimately it's how we get to that journey together and how we can kind of like help shape that, but without putting all the burden on us, because we can't deliver all of this. But what we can do is part of the eco structure that moves toward that overall goal.
Yeah, thank you, Hugh. Looking at the timing, I guess we'll have time for one more question. Let's make it an easy one.
Sorry, Dieter, I got the microphone before you said easy one. But hopefully it's a short answer. With some colleagues, we were discussing over lunch about this panel, talking about next steps. And clearly the journey has already started with scenario analysis. Many publications so far indicate that firms so far have been publishing results that indicate manageable impact from climate change. However, they indicate the systemic risk which is managed by regulators, modelers, firms alike, all of you in the panel today. This systemic risk, however, is challenged by the reality of current systemic risks such as inflation, war, the current macroeconomic environment. Does this put a risk to the effectiveness of the next steps for climate risk assessment? Thank you.
If I can maybe start answering that question, I do see risks there where the current macroeconomic environment, let's give an example of the high energy prices that are caused today. If the current macroeconomic environment would lead to a delay in action, and that's general for the general public, it's definitely not only, it's valid for politicians, it's valid for insurance companies as well, it's valid for regulators. So to the extent that the current macroeconomic environment would delay the necessary action that we need, I do believe that that could pose or increase the risk related to climate at a later stage on the timeline. But I'm happy to check if my fellow panelists feel the same, or whether they have any additional viewpoints I would like to add to that.
Yeah, this is going to be a record. I'm going to agree with the regulator twice on the same panel at the same night. I do think that impact of back today, I think it really can go both ways though. It's interesting, that energy one is really, how does that debate go? That's above our grade, and it's a very political discussion. Is that energy crunch going to accelerate or decelerate? Yep. It can go one or two ways. I mean, it's not a tipping point to that extent, but is it going to... Are the difficult questions going to lead to a straightforward answer, or are they going to defer the issue? And I think that's a real challenge that we can't control. But I do think that debate. I mean, a few, but then if you look at generationally, if you look at when we're talking about our customers really do care about these things, especially our younger generation customers. So I think it's quite good to not link this, completely decouple this from our customers and the market share that we do have and the influence on that side, because I do think that there is that danger that it get deferred. That's kind of like, but I think there's also that likelihood that, or possibility that perhaps it will accelerate because the difficult questions are now crystallizing. You have to decide which way you're going to go.
There's definitely also a social element to this question, where if we need investments both on political level, on personal level, I would say, but if in the end of the month the high inflation makes that there is no money left, then it is really a battle, I would say, to make sure that the climate aspects are kept on the agenda. And we see that every day lately, I guess, also on what is happening, and you see it in the news, and it's definitely a big challenge. It was not an easy question, but it was at least a very interesting one. Thank you for that. Allow me to wrap up the panel. I think we've heard today, and I could not have said it better than what was mentioned by several of my panelists, we are here a little bit in the same boat, in the same journey. We need to learn from each other. First of all, we need to learn as a supervisor. And I think Daniel mentioned the workshop we're doing. Those supervisors that are a bit more advanced than others can definitely share their experiences amongst each other. But we shouldn't stop there. There is also room for joint discussion, joint initiatives between supervisors and insurance companies, collective action also, as you mentioned, and if you look a little bit at the different challenges in more detail, data issues, and it was flagged by the audience, is definitely something we should continue to work on. On the liability side, we've heard Robert say there are good developments in CAT models, but more work is needed. There is more work needed also in terms of understanding how some of these models work, changes that may be needed due to climate risk, and we need to take into account also the uncertainty in those models, because if you rely on the models, mistakes, as we heard, could happen. On the asset side, there is definitely room, I think, for keep on digging, get to the necessary granularity, both for ourselves as supervisors, but also for insurers, to make sure that we have those breakdowns at the level that we need them to be able to model the asset side in these long trajectories that are needed if you want to model climate risk. This long-term perspective is part of the challenges, such as making sure that as a supervisory community we provide you with scenarios that are not too different in nature, although we've heard a few times today there may be need for local nuances as well. So looking ahead, and I think Robert warned us very well on maybe or probably not achieving the 1.5 degrees target, and I here like to repeat the words of you. Early action is better than late action is better than no action, and there are quite some challenges ahead of us in terms of climate risk. There is this insurability question that could leave people with protection gaps. It's something we will need to work on together again as supervisors and as industry. We need to also, on the asset side, try to translate some of the climate scenario paths we project and try to assess what this could mean for the value of those assets. So there is work to be done here at this level. There is work to be done, so that means Daniel will definitely not be out of work for the next few months and years. And we'll keep climate risk on the agenda, that's for sure. And we cannot lose any more time on this topic, so we'll be busy for quite some time. Thank you all for listening. I hope you found it an interesting panel. And I'm happy to give you, is it coffee break now?
Yes, it is.
Yeah, here we are. Happy to move on to the coffee break. Thank you.